One economic indicator is signaling inflation is not all that conquered, and the Federal Reserve's monetary policy is still far too loose. The statistic in question is normal gross domestic product, or NGDP growth. That is, the growth of economic output before adjusting for inflation. It stands in contrast to a range of other signs inflation is receding. The inflation rate is falling, inflation expectations are dropping, wage growth is moderating, job openings are declining, and investors now expect the Fed's next move will be to cut its interest rate target. In the third quarter, NGDP surged, growing at nearly 9% annualized rate, the fastest growth in 20 years. Setting aside the massive numbers posted during the reopening from the pandemic, NGDP has been identified as an important signal of how hot the economy is running by many monetary policy experts. It is favored because it is a measure of total spending across the country. Rapid growth suggests people are spending freely. Absence of a sudden massive surge in productivity and/or labor force growth, some of that excess spending is going to show up as inflation. As an example, if inflation were running at the Fed's target of 2% and NGDP were growing at 9%, that would mean the real economic growth was 7%, an explosive number that strains credibility. More likely, all that spending is translating into higher inflation.